Welcome to the first episode on Benjamins with Ben. In this episode, we're going to cover The Ultimate Beginner's Guide to Investing, which is a post available on my blog, link in the description. Subsequently, in this video, I'm going to go through what is a stock, what is a bond, what is a dividend stock, what is an ETF, and how can I open an account to buy stocks and bonds. We will start out with the first thing on the list, which is what is a stock? So stocks are shares of company ownership that can basically be bought or sold between people or institutions, usually on an exchange like the New York Stock Exchange. So if a company is worth $1,000 and has 100 shares, the price of one stock or one share would be $10. A bond is a little bit different than a stock. So a lot of times when we were talking about investing, we'll hear stocks and bonds almost used interchangeably. It's not really the case. They're pretty different securities. A bond is basically a loan that's given to a company or a government body with a promise that that company or government will eventually repay that. A lot of times, bonds will pay you interest in return for holding that bond. So because you're taking on risk by giving out a loan, you get compensated for that risk. It tends to be that if a company is giving out bonds, they need to raise capital of some sort, which means they're strapped for cash. Either they're not creating enough cash flow or they're not getting that money from somewhere else. So they sell bonds in order to raise money. So that's a good scenario of when a company would want to sell bonds. If the company runs into trouble, bondholders get paid out first. So those are usually perceived as less risky than holding something like a stock or a share of the company. Because if that company goes to zero, you may not get anything. Or you might get a couple dollars if we use the example from earlier, like maybe the company goes bankrupt and those shares are worth $2, you might get $2 when they go under. More likely you'll get nothing, and you paid $10 for the share. So dividends are similar to bonds in that they pay you on a schedule, but they required you to hold shares or stocks. They are effectively a cash reward from the company that is given out in exchange for holding shares of the company. If the business makes money, the value of the share may increase, which is great if you're thinking about capital gains and you sell that share further on. Then whatever the difference between what you bought the share for and what you sold the share for is going to be your capital gains. So it's money you make on that share. And you may also receive some profits if that stock happens to pay dividends. The money you receive is typically proportional to the number of shares that you hold in that company. So if a dividend yield, so this is going to be what we want to look for on the stock when we're trying to figure out whether or not it even pays a dividend. As an example, if the dividend yield is 4% annually, you own 10 shares, each share is valued at $100. When you bought them, then you'll get $4 the first year, assuming that the price does not change. Using the same math, to earn $1,000 a month in passive income, you need to have about $300,000 invested into that company at that 4% interest or that 4% dividend rate. Jumping into the next topic, we're going to just quickly give a brief overview of ETFs. I'm going to go in much more depth in a future video, but it's still important to cover just broadly what is an ETF. This term is thrown around a lot. Not a lot of people know what it is when they first get into investing, but an ETF is an acronym for an exchange-traded fund. I think of these as a pan with a bunch of different slices of pie, but each slice is a different flavor, if each flavor is a certain company. So there could be, I don't know, only a few slices, like 6 slices, 10 slices, or there could be something like the S&P 500, where there's 500 slices. Or it could be something like the Russell 1000, and there's 1,000 slices. The weight of each company within one of these pies is based on their market capitalization. So it's the value of the company. So more value, bigger slice of the pie. But this could vary from ETF to ETF based on the philosophy of that ETF. Whoever created it, if it's actively managed, whoever the ETF manager is, based on their philosophy. So you can get quite a bit of variance in terms of if you're exposed to just domestic markets, or if you're exposed to international markets, or if you're exposed to stocks with a lot of pricing power, etc., etc. Now you have a brief overview of what a stock, a bond, and an ETF are. So, next step, how do you buy them? To be able to purchase securities like stocks, bonds, ETFs, you'll need something called a brokerage account. There are also a few other tax-advantaged accounts that you can buy securities through, but different topic. Brokerage accounts are financial products offered by brokerage firms. So, a brokerage firm could be Fidelity, Charles Schwab, E-Trade, TD Ameritrade. Could be Robinhood, could be Webull. Most of these online brokerages offer low to no fees for purchasing securities, which is pretty great. And a lot of that is thanks to companies like Robinhood, which decided that they would just do away with brokerage fees. It used to be that you'd have to pay like $30 every time you wanted to buy a stock, because the broker would have to get paid. It used to be a person. You'd call them up, you'd say like, hey, I want 100 shares of Microsoft. Can you help me out with that? And they'd be like, yeah, we can do that. I use Charles Schwab for my primary brokerage. It used to be that Robinhood did not have 24-hour customer support. They now do have 24-hour customer support, so that's huge. I have Charles Schwab because USAA, which is my primary bank, used to have brokerage accounts, but they sold the rights to those accounts to Charles Schwab, and so now my accounts are with Charles Schwab. That said, my experience with them has been great. The customer service is fantastic, so you could, if you wanted, make an account with Charles Schwab. I'll post a link down below, and if you want, you can use it. I don't think I get anything for that referral link, so if you do, you do. If you don't, you don't. I know Fidelity is also great, so later on in this video, we're going to cover how to make an account with Fidelity. I like to use Charles Schwab and larger firms like Fidelity because they usually have some sort of SIPC and FDIC insurance. I also like that Schwab always has a real person that I can talk to on the phone, no matter what time of the day it is, which I think is a really important thing to look for when you're choosing financial institutions to work with on the investment side and bank with. If you can't get a hold of someone 24 hours to basically be able to access your money, I view that as a big problem. If there's an issue with my life savings or investing, I don't want to be stuck in a frustrating phone tree with Wells Fargo or Bank of America. Opening an account at one of these firms is pretty similar to how you would open a checking account with your current bank. Usually all you need is your social security number. To open an account, there's a few simple steps. So first, you're going to want to create the account. Second, you want to link it to your checking or savings account or whatever other account you want to fund it from. The next step would be to fund that account. So you can either make a transfer from a linked account. Most brokerages offer automated transactions. I have mine set up to automatically transfer money after each paycheck I receive. My mentality here is that if I don't see it in my checking, I don't spend it. Once your account is funded, go buy some stocks, bonds, ETFs. My favorite are Vanguard ETFs like VTI and VOO. They offer pretty broad exposure to most things in the market. They have really good historical returns and very, very low expense ratios. Expense ratios are just fees. So basically, if you have a brokerage account, you buy a security. If that security has an expense ratio of 0.03%, that's what you're going to pay every year to whoever puts together that portfolio. So in this case, it's Vanguard for something like a VTI or VOO. That's really, really low fee. 0.03% is what they usually charge on both of those funds. However, you should be really careful with fees. Actively managed ETFs can often have fees up to something like 1%. That 1% fee can really eat into your capital gains over time. We'll cover that in a different video, but long and short of it is that if anything financial related, be it you're paying for a financial advisor, if you're paying them a 1% AUM fee, that's going to be really, really, really expensive over 10, 20, 30 years. A lot of brokerages now offer automation of investments, so you can basically have money deposited in that account, have some sort of automated transfer set up that just recurs after every paycheck, and you can set up an AIP, which would be an automated investing plan, or just a recurring buy of specific securities. So using Charles Schwab as an example, I can go in and basically set up a recurring buy for any Schwab mutual fund. So sometimes those mutual funds are actively managed, in which case their expense ratio is quite high. Sometimes they're passively managed, means their expense ratios are going to be as low as Vanguard's, usually around that 0.03%. Something that I really wish someone had showed me. I think I probably ended up watching something on YouTube about this, but just because we have a promo from Fidelity, or at least I do right now, there's this nice little thing where if you deposit at least $50, then they'll give you $100. So we're just gonna get started with that. Okay, so now it's gonna ask us to choose an account. So it says a starter pack. So this is a cash management account and the Fidelity account. So one is for investing and one helps with cash management and spending needs. So it sounds like the cash management is kind of like a checking account, and the Fidelity account is for everyday investing. I think we're just going to do the Fidelity account. So we're going to open a single account. So this will take us through the steps to do that. So just go through the prompts, answer all the questions they have. So are you a Fidelity customer? No. And they want me to do employment information. That's fun. Okay. So they'll need a few details and you'll need to fill out this form. So we'll just go Benjamin Clark. And let's just not show all of this information. So I will be back in a second as soon as we're on to the next step. So you're going to fill out these details and these details, and then we'll go into employer details. There we go. Here we can see the individual brokerage account. It's just called individual. We might rename that at some point if we can. But you can see there's no money. So the first thing we want to do is transfer money, and then we'll go through here and we'll link a bank account. So it is going to be an electronic funds transfer, an EFT, not to be confused with an ETF. And I will be doing it for myself. It's not for a business. And we're going to use Plaid, which is a cool service. So once that money hits our account, we'll be able to place a trade. So we've got our pending activity up here. And we'll see if it'll let us do it. So we are going to buy the Fidelity Composite Index Fund and see if it will let us do that. Yeah, it'll let us do a dollar amount. So we're going to do that full $50. And that'll tell us how much it's going to cost. So that's going to spend that money that I deposited. I'm going to preview order, and we are going to place that order. So after next market close, that trade will execute. And then we'll get cash debited from core in 1 to 2 business days. So from here we can manage orders and click that order page, and we can see there's a pending order there and that is open. So now that we can see we've got $50 of FNCMX pending. If you have any questions, please leave them in the comment section down below. Let me know what you want me to cover next. And as always, don't forget to smash that like button, comment, subscribe down below, and we'll see you next time.